you invariably talk about a comparison between loans and financing in Islamic finance. The capital markets business that is often talked about, Islamic capital markets, is really a debt capital markets in the conventional parlance. And I've got two charts here. The one on the left-hand side talks about the high-yield loan market in the UK, in Europe. And if you note from that, since the financial crisis, it's fallen off the cliff from the dizzy heights of nearly 250 billion per annum, all the way down to where it is now, just about 50-ish. There's two elements of that. One is just a reflection of where the banking market is in the UK, and the second thing is that there's almost no appetite for syndications. And you need to look at the high-yield markets specifically because that's where majority of mid-cap organizations tend to sort of borrow money. If you look at the comparative with Islamic finance, majority of the Islamic finance borrower also fall into the sub-investment grade. If you take the government issues outside, and many of the governments are still not investment grade, by the way, the biggest issuer of Islamic capital market is really Dubai, and that's not a rated entity by itself. But we've had consistent growth, and this is the data from Ernst & Young that I mentioned, and majority of punters and commentators value the Islamic financing assets over $1 trillion now. That growth needs to be qualified a little. For example, the government of Islamic Republic of Iran is included in that, but that sort of business is not really, whilst it's regarded as Islamic finance, it's not actually in the larger Islamic finance community and isolated. And some of the other ones are included in there, which is really more of a domestic market. The Turkish market is quite a large market, but it's very limited because in Turkey they haven't expanded Islamic finance beyond the 4 participation banks. So there are swings and roundabouts with this data, but what it clearly shows is that whilst the rest of the market at the same time has fallen off, the Islamic market has continued to grow. The key reason there is that as a niche, it was always had space for it to grow, and the significant more capacity that was underestimated. The second thing is that it had the liquidity to grow, and the majority of the issues with the left-hand side chart is that there was no liquidity, and that's a recurring theme in Islamic finance, which in current situation is a key advantage for many of the conventional borrowers to look at. This is a self-made chart, and I come from a consulting background, and you tend to sort of compartmentalize things. And it would have been nice if I could have actually done it so things appeared in sequence, but I've basically divided into 4 eras or periods. In '75, when Dubai Islamic Bank, the creation of IDB and Kuwait Finance House came about, it was really a response to what I would call faith or inclusion agenda. And there was demand by Muslims not to use conventional banking, but to use an alternative. A very, very important task. And these organizations never claimed to do anything other than that, just to fulfill that need. It was really concentrated around GCC, although other markets like well, certainly around the MENA region and Malaysia had reference to it. But in terms of banking activities, some of the oldest are included in Dubai Islamic and Kuwait Finance House. Very, what I would call primitive product set, investments by way of profit share, the wakala contracts that you're familiar with, and financings were largely by way of direct murabahas. None of the consideration of the modern interpretations of tawarruk, etc., were there, largely because you're talking jurisdictions that tax was not a big issue, and financing was not such a large financing transactions. And what I would call is that at that stage of development, it was definitely not an OECD offer, because a number of issues will arise when we start talking about taxation and the impact that that has in Islamic finance. I think the second phase is when this was really taking some scale issues, and factors such as regulation and consistency, standardization came about. You see the development of AOFI, IFSB, the whole Sharia scholar movement. Everything started to sort of give some framework and to this. Sorry if I'm repeating a lot of these, which is familiar, but I think in following this journey to why the capital market has some of its advantages and disadvantages, it's important to take note of these. I think as part of that standardization, you saw the growth across MENA into other regions, for sure, and in Malaysia. And the one other issue that came about was this element of a different Sharia approach to Islamic finance, and the subsidiarity that exists of having different interpretations. I think around 2000, what I call the capital markets era, we started seeing sukuk and other interbank activity. I've called it the investor arbitrage driver, because some people realize that if you did something under Sharia, you actually could be economically better off. We saw some of the mid-2000 issues by the windows where they legitimized actually charging more financing return under a Sharia structure for exactly the same credit as opposed to under conventional structure. So investors tend to invest in this sort of financing largely because they got a better return for the same risk. Not fair, but a debut perhaps argument. But very much the players in this market were the windows, as you recognize them, the conventional banks that saw the opportunity of offering Islamic finance as an alternative for attracting the investors. And I think when we came about in 2007, but precursor to that, Islamic Bank of Britain, European Islamic Investment Bank, and others, was really to flow the liquidity that we saw in significant surplus in 2006 and 2007. The Middle East always has trade surpluses because of its oil exports. But in bringing the industry out, so for two reasons. One was diversification. So you didn't want to have only exposure to Islamic assets in GCC. You wanted to have the exposure also in Europe and other parts, an important part of the risk management. Second, though, was to develop products. And if you see majority, with the exception of the Islamic Bank of Britain, which was an important investment and also an important underinvestment, in my opinion, for a retail bank not to have proper capital investment behind it. But to bring wholesale banking in markets that allow development under English law of development of new products for this sector, which is needed significant advancement for products, especially to what I would call the OECD requirements. So a big driver for level playing field. Level playing field means that the mindset of everybody in banking is centered around a framework which is largely defined by debt. Matthew, will, as a lawyer, will tell you a lot more about this, but if you enter into a finance agreement, the whole language and interaction with the borrower is a debt framework. And the concept of risk sharing, which is the principle of Islamic finance between two entities, it gets completely prejudiced by this framework. And you need to either say that, yes, we like to offer debt, which is under our Murabaha and Ijara contract, and everything then follows the framework that we have under English law for this. Or if you want to enter into musharakas and other form of contract which is more equitable in Islamic financing and its risk sharing, then you just can't fit in with this framework because it penalizes the banks unfavorably. This level playing field, I think, is best addressed under English law and the alternative finance legislation, which I think, if you actually look at it in jurisdictions where Islamic finance is most used, like the GCC countries, none of it is actually addressed in their civil law legal framework. So an important concept which is developed here, and that was the basis of why when we were arguing with the HMT and the legal framework here for the banking, that in order for us to develop the wholesale side, a lot of this needs to be in place. Just to point out that as part of this data collection, I made the point earlier that GCC remains to be an important market for banking assets, and some of the largest growth is expected to come from the GCC over the next 2 to 3 years. And the principal reason for that is effectively the liquidity surplus which will fuel this. And the fact that Islamic financing is now reaching a certain degree of maturity in these markets, that the contract of Islamic finance is now fairly well understood and accepted. It's notable to say that some of the largest Islamic banks are actually now in Middle East, to count amongst them Al-Raji Bank, Dubai Islamic Bank, and Kuwait Finance House. These alone account for about 20% of the banking assets. It's notable to point out that what's commonly offered in conventional banking is more or less also delivered in Islamic banking. And very readily you would find Islamic banking or bankers would say that we pretty much deliver any form of financing you require using a Murabaha structure. Well, I don't think life is only limited to Murabaha structures. We have, and as Aofi and also the Sharia scholars, we have to use the wider choice. For syndicated fixed loans in the conventional market, the equivalent is a syndicated Murabaha transactions. Majority of these are structured around the metal trade, but we completed only 2-3 weeks ago a transaction in BLME with Turkish syndication where we use the actual underlying commodities for it. So there's no need to always use the metal trade. You can actually use the trade flow itself. And I don't think we use trade finance enough in Islamic finance for that purpose. Certainly, Ijara transactions are very naturally adapted to Islamic finance. The principal issue in Ijara is the issue of capital allowances and the taxation in change in ownership, and that does give a headache. But I think as long as you account for these things up front and go with understanding the accounting policy, you should be okay. On the off-balance sheet, the Ijara Sukuk matches the true sale securitization, and we can structure in the UK government has allowed for that to be done for property as well as for physical assets. Again, another slide on the importance of Sukuk issue globally. Sukuk is the main product in the capital markets for Islamic finance, and it's been steadily growing. This year anticipated to be about, in 2011, 67 billion, GCC accounting for about a quarter of that. But if you look at the chart on the right-hand side, which looks at both bond and Sukuk alongside one another, you see that it's actually, in some instances, Sukuk issuance is on par with bond issuance in these markets. Granted, it's a relatively new market for either instruments, but it just shows that the principal issuers in the Middle East are now considering issuance of Sukuk on the same basis that they would issue bonds. That's partly because the investor market for this instrument is now fairly well established. I think the second part to this is that previously it was automatic to assume that a sovereign wealth fund would, or a government agency, because it's in the Middle East, would issue Sukuk. In fact, majority of them would issue bonds for their financing. But they've now seen the market having been developed to a mature status that they're equally tapping both markets. And that's, I think, a good sign, a positive sign for the Sukuk market going forward, that it's now showing some sign of maturity.